One letter can detonate your life, and right now, that letter is landing in mailboxes across California, threatening the four things you cannot live without: groceries, fuel, rent, and medicine. More than $1 trillion in California home value is chained to one simple requirement: continuous insurance. And that chain is snapping in real time. When insurance disappears, the mortgage does not politely wait. It accelerates, it demands proof, it raises escrow, it spikes payments, it drags families into default, and it does not care how hard you work or how long you have lived there. Maria Gonzalez keeps her cancellation notice folded inside a Ziploc bag so it will not tear. She is not being dramatic. She is being practical because the paper feels like a death certificate for a life she built one paycheck at a time. Her house in the foothills was not burned, not flooded, not looted. Her house was simply labeled too expensive to insure, and the label is all it takes. She did everything the state asked. She cleared brush, she replaced vents, she paid for hardened upgrades, and she did it while her grocery bill climbed to $287 a week for a family of four. Then the insurer left anyway. The governor says the system is being stabilized, that reforms are coming, that Californians will be protected. And while the governor promotes these policies publicly, the reality on the ground is homeowners are being shoved into a shrinking lifeboat and the water is already inside it. This exodus is not just corporate greed, not just climate fear, not just a bad year for fires. It is a domino line built by policy decisions, regulatory bottlenecks, and a refusal to face simple math. Insurers price risk. When they cannot price risk, they leave. When they leave, homeowners scramble. When homeowners scramble, lenders tighten. When lenders tighten, construction slows. When construction slows, housing supply contracts. When housing contracts, rent rises. When rent rises, workers leave. When workers leave, small businesses collapse. And when small businesses collapse, you get retail deserts where the only thing left to buy is disappointment at a premium. Robert Chen thought he was safe because his job is stable and his credit is clean. He works in logistics, he budgets down to the dollar, and he has never missed a payment. His lender did not congratulate him for being responsible. His lender told him his policy was being replaced with force-placed insurance, and his monthly payment jumped by $639. That number is not a statistic. That number is Robert skipping dental work, stretching oil changes, and telling his daughter the soccer season might have to wait. Force-placed insurance is not a careful replacement. It is a blunt instrument, expensive and narrow, designed to protect the bank, not the family. It is the system's way of saying your stability is irrelevant. It is also the beginning of economic gravity, the invisible weight that drags even strong households into panic. You can feel it in the way neighbors stop repairing fences. You can hear it in the way couples stop talking about vacations and start talking about selling. You can see it in the way a neighborhood goes quiet because everyone is doing the same math in silence. Aisha Malik is doing that math at her kitchen table with a calculator and a half-empty bottle of insulin. Her husband's hours were cut, her premium quote tripled, and her deductible is now a number so high it feels like a joke told by someone who hates you. She is rationing medication not because she is irresponsible, but because the system is demanding too much at once. She is choosing between medical stability and housing stability. That is what this exodus does. It turns the middle class into triage nurses for their own lives. The official explanation is always polished. Wildfires, reinsurance costs, catastrophe losses, market cycles, but none of those words explain why California, the wealthiest state in the nation, can allow a basic pillar of home ownership to fracture. The answer is in the mechanisms, and they are painfully specific. Rate approvals take too long. Rules limit how risk is modeled. Mandates pile on compliance burdens. Litigation risk remains high. Permitting delays prevent mitigation and rebuilding. And enforcement timelines shift like sand, leaving both homeowners and insurers stuck in uncertainty. Uncertainty is poison to insurance. Uncertainty is also a political choice. Daniel Park bought his home 5 years ago, a modest place he planned to keep for decades. His insurance renewal used to be routine. Now it is a hunt, and every quote feels like a financial grenade rolling across his budget. One company offered a premium of $940 a year with exclusions that read like an escape clause. Another company offered nothing at all. He called agent after agent, and the agents did not sound greedy. They sounded tired, like people working a disaster hotline. They told him the market is hardening, that carriers are pulling back, that appetite is gone. Appetite is a polite term for willingness to tolerate risk. California has been demanding tolerance while restricting the tools insurers use to survive. That is not compassion. That is willful blindness. And while the governor promotes these policies publicly, the reality on the ground is families like Daniel's are being forced into last resort plans with higher costs, narrower coverage, and delayed payouts that can break a household after a fire, even if the house is still standing. The dominoes do not stop at the homeowner. They hit the contractor who cannot get projects financed because the builder's risk policy is unavailable. They hit the realtor who watches deals collapse days before closing because insurance cannot be secured in time. They hit the lender who tightens underwriting across whole zip codes. They hit the city that collects fewer transfer taxes, fewer permit fees, fewer property tax increases. They hit the school district when families move and enrollment drops. They hit the hospital when staff cannot afford to live nearby and commuting becomes a second job. This is not a localized crisis. It is a systemic squeeze that spreads from neighborhood to city to region, then snaps back into your pantry and your gas tank. Because when housing becomes unstable, everything becomes unstable. A family that is terrified of losing its home stops spending. They stop eating out. They stop fixing the car. They stop hiring help. Small businesses feel that slowdown first, and they feel it hardest. Lynn Tran runs a small hardware store that used to thrive on weekend projects and local repairs. Now her customers come in with haunted eyes, asking about the cheapest smoke alarms and the smallest boxes of screws. They are not building patios. They are boarding windows. Her own insurance premium jumped to $1,400 to $200 a year for the business policy. And the quote came with a warning that next year could be worse. That is not just her problem. That is the warning label on an entire local economy. When small businesses cannot insure, they close. When they close, your town loses services. When services disappear, those empty storefronts become the first signs of retail deserts. The place where choice dies and prices rise. And while the governor promotes these policies publicly, the reality on the ground is the closures will be blamed on greed, on bad management, on online shopping, anything except the regulatory choke points and cost burdens that are squeezing local commerce from every direction. There is a reason insurers call this a capacity problem. Capacity means how much risk the market can hold before it breaks. California is loading more risk into the system while also making it harder for the system to adjust. You cannot command a private market to ignore losses. You can only incentivize it to stay or punish it until it leaves. Leaving is what we are watching, and the most dangerous part is what happens after they leave. The last resort option expands, and when last resort becomes first resort, it becomes fragile. Fragile systems fail suddenly. They do not fail politely. They fail when you need the most. Sophia Ramirez is a single mother in a high desert community where wind turns a spark into an inferno. Her policy was non-renewed, and her broker guided her to a last resort plan that costs $4,060 a year for coverage that still leaves giant holes. She paid it because she had to. Then her car needed brakes. Her son needed asthma medication, and her rent on a small duplex for her sister went up by $225 a month because the landlord's insurance also skyrocketed. That is the domino effect in a single household. The same risk gets priced again and again, passing through every layer of life until it lands on the person least able to absorb it. The governor's agenda is often framed as protection, consumer protection, environmental protection, worker protection. But protection that ignores incentives becomes a trap. If rate processes are slow and unpredictable, insurers will not wait. If catastrophe modeling is restricted or delayed, insurers will not guess. If mandates raise operating costs and litigation remains a threat, insurers will not gamble. They execute a calculated retreat, not because they are villains in a story, but because they are businesses responding to a signal. California is sending the signal that risk cannot be priced quickly enough to match reality. Reality does not pause for hearings. Reality does not respect press conferences. Reality burns, floods, and blows. And while the governor promotes these policies publicly, the reality on the ground is homeowners are getting hit with renewal offers that look like ransom notes. And the families who cannot pay are quietly pushed towards sale signs. Those sales do not just change who lives there. They change what the community becomes. When insurance costs spike, investors with cash can still buy. Families with mortgages cannot. So neighborhoods tilt. They shift from rooted to rented. They shift from stability to churn. They shift from people who attend school board meetings to people who are just trying to survive until the lease ends. And that churn has a price. Ask the teachers watching students disappear mid-semester. Ask the clinics watching patients skip appointments. Ask the grocery store managers watching baskets shrink. Weekly grocery runs that used to be $170 are now $246. And that extra $76 does not come from nowhere. It comes from canceled after-school programs. It comes from skipped prescriptions. It comes from unpaid utility bills that snowball into shut-off notices. Insurance exodus is not one crisis. It is a pressure multiplier. It squeezes every other expense upward until something breaks. There is another mechanism that almost never makes the speeches: reinsurance. Insurers buy insurance for themselves. And that backstop has gotten more expensive as disasters multiply. In a healthy system, companies adjust prices and coverage to reflect that cost. In a constrained system, they cannot, so they shrink. They stop writing new policies. They pause renewals. They non-renew blocks of homes. And homeowners become collateral damage in a global risk market they never asked to join. The state can pretend this is a temporary storm, but homeowners like Marcus Williams know storms are not temporary when they start living inside your budget. Marcus is a firefighter, and the irony is brutal. He fights the fires that drive insurers out, then goes home to a mailbox that tells him he is no longer worth the risk. His new premium quote came in at $6,130 a year, and that is with a deductible so high he jokes he is basically self-insured. He is not laughing. He is calculating how many overtime shifts he can take without missing his kids' birthdays. He is calculating whether to move out of the region he protects. When firefighters, nurses, and teachers cannot insure their homes, you are not dealing with a market inconvenience. You are dealing with civic decay. The dominoes hit public safety. Next, response times lengthen. Staffing gaps widen. Burnout accelerates. This is economic gravity again, dragging essential workers away from the places that need them. And once they leave, the risk gets worse and the cycle tightens. That is why this moment matters. Not because it is dramatic, but because it is compounding. The governor can announce task forces and timelines and frameworks, but timelines do not stop cancellations. Frameworks do not pay premiums. Task forces do not keep escrow accounts from exploding. What would keep families stable is speed, clarity, and incentives aligned with risk reduction. Instead, too many policies have created bottlenecks. Permitting delays prevent homeowners from hardening properties quickly. Building requirements can raise rebuild costs. Compliance burdens stack on insurers and contractors. Labor rules, while often well-intentioned, can amplify rebuild expenses in a disaster zone. Every added cost raises insured values. Every raised insured value raises premiums. Every premium spike pushes another family to the edge. That edge is where landlords get hit next. When multifamily property insurance climbs, rent climbs with it. Landlords pass on costs because they can and because they must. Tenants do not get a hearing, they get a notice. Jessica Lee received hers on a Tuesday, rent up $350 a month starting in 60 days because the building's insurance renewal went up. Jessica works 2 jobs and still counts dollars like they are oxygen. Her gas costs about $92 a week because her commute is long, and now she is considering moving even farther away to find a cheaper place. That means more gas, more time, less childcare, more exhaustion. That is how an insurance exodus turns into a family breakdown. It is not dramatic, it is mechanical. And while the governor promotes these policies publicly, the reality on the ground is rents are rising not only because of housing shortages, but because insurance is becoming a hidden tax on every roof, and tenants are paying it without ever seeing a policy. The state's last resort programs swell under this pressure. When more people pile in, the pool becomes riskier. When the pool becomes riskier, costs rise again. When costs rise again, more people fall out of the private market. It is a feedback loop, and feedback loops do not end gently. They end in failure or in a hard reset that leaves casualties. The hard reset looks like massive assessments, sudden premium spikes, delayed claim payments, and households forced to leave because they cannot afford uncertainty anymore. That is the exodus that follows the exodus. Homeowners leave first, then businesses, then workers, then the tax base, then the services, then the cohesion. And what remains is a hollowed map, expensive but brittle, glamorous in brochures but fragile in real life. There is a reason lenders are watching this with fear. Insurance is the glue that holds the mortgage system together. Without it, the 30-year promise becomes a 30-day panic. Banks do not like panic. They respond by tightening credit. Tightened credit means fewer buyers. Fewer buyers means slower sales. Slower sales mean falling prices in risk zones. Even as prices remain high elsewhere, that creates inequity inside the same county. Some neighborhoods become untouchable. Some become bargains for cash investors. Families lose the wealth they thought they were building. That is a slow motion transfer of stability from households to institutions. It is not a conspiracy. It is the logic of a constrained market, and every step is anchored in the same thing: insurance capacity shrinking under policy friction and escalating hazard. Nina Patel is a real estate agent who has watched deals implode at the final hour. The buyer is approved, the appraisal is done, the inspection is clean, then the insurance quote arrives at $12,300 a year, and the buyer's monthly payment becomes impossible. The buyer walks, the seller panics, the listing sits, the neighborhood hears the rumor, and suddenly everyone wonders if they are next. Fear is contagious. It spreads faster than fire because it spreads through conversation. And when fear spreads, spending stops. When spending stops, the local economy freezes. Freezing is what turns a manageable crisis into a recession inside a single region. This is why the governor's reaction matters, because leadership is not about sounding calm. Leadership is about removing bottlenecks that strangle the system. It is about acknowledging that regulations have costs, mandates have trade-offs, and delays have victims. It is about telling the truth that you cannot legislate away economic gravity. You can only lighten it by reducing risk and allowing markets to reflect risk honestly. Instead, Californians are being served reassurance while their bills scream. A family paying $350 a month on a mortgage cannot absorb an extra $700 without cutting something essential. That cut is often health care. It is often food quality. It is often childcare. It is often car maintenance that later becomes a breakdown on the freeway, which becomes missed work, which becomes a smaller paycheck, which becomes the next missed payment. That is the domino logic. A single premium spike can start a chain reaction that ends in eviction, foreclosure, or medical crisis. The state's messaging rarely names that reality. It names values. It names goals. It names intentions. But households do not live on intentions. They live on cash flow. And cash flow is now under attack from every direction. Utility bills rise as infrastructure strains under heat. Gas prices swing and rarely swing down enough to feel like relief. Grocery prices stay elevated. Insurance becomes the new monster in the closet. The bill that shows up once a year but can destroy you in a single swipe. For some families, it is not once a year anymore. It is monthly through escrow, a steady bleed. This is how a market exit becomes a life exit. People leave the state because the state has become too complex to survive in, not because they hate it, but because they cannot keep paying for uncertainty. That is the quiet exodus you do not see on the news. U-Haul lines, packed garages, farewell yard sales, children crying because they are leaving friends, parents smiling while swallowing panic. The governor can call it mobility. The families living it call it loss. And while the governor promotes these policies publicly, the reality on the ground is the people leaving are not just the wealthy chasing tax breaks. They are working families fleeing instability, and their departure accelerates the very fiscal stress the state claims to be managing. When enough people exit, the dominoes hit public budgets. Less tax revenue means harder choices. Harder choices mean cuts or higher fees. Higher fees mean higher living costs. Higher living costs mean more exits. This is not speculation. It is the shape of the spiral. And every stage has a human face. Carlos Mendoza runs a small trucking company and keeps his rigs insured with narrow margins. His commercial policy renewal climbed by $18,900 this year across the fleet. He tried to absorb it. Then diesel rose again and maintenance costs followed. Now he is considering laying off 2 drivers. 2 drivers means 2 families. 2 families means 2 sets of rent checks at risk. 2 families means 2 sets of kids whose school supplies might not get bought. All from a policy renewal most people never hear about, tied to the same insurance capacity crisis hitting homeowners. This is why the governor appears stunned, because the consequences are no longer abstract. They are showing up in the heart of the middle class, and they are measurable. They are the $560 increase in a monthly mortgage payment. They are the $4,200 annual premium that becomes $8,900. They are the $12,500 deductible that becomes $10,000. They are the $300 rent hike justified by a landlord's new policy cost. They are the $47 delivery fee for groceries when a local market closes and the nearest affordable store is now a 40-minute drive. That drive is not just inconvenient, it is expensive. It burns fuel, it burns time, it burns patience. And when enough communities lose nearby services, retail deserts expand like a stain. Retail deserts are not just about food. They are about everything that makes life manageable. Pharmacies, clinics, auto repair, childcare, even basic banking. When those disappear, families become isolated. Isolation increases stress. Stress increases mistakes. Mistakes increase costs. And then economic gravity pulls harder. This is the part officials rarely say out loud. California is becoming uninsurable in pockets, and those pockets are growing. Even people nowhere near the wildland interface feel it, because insurers spread risk. Reinsurers spread risk globally. Markets are interconnected. The dominoes travel through spreadsheets and regulations until they land in your mailbox. So what happens next is not a mystery. If the state continues to move slowly, the private market continues to shrink. If the private market shrinks, the last resort pool swells. If the last resort pool swells, it becomes a bigger target for financial stress. If it becomes stressed, assessments and costs can rise across broader populations. That is how a localized crisis becomes a statewide bill. A statewide bill becomes a political crisis. A political crisis becomes rushed policy. Rushed policy becomes unintended consequences. Consequences become the next financial grenade. This is the cycle people are living inside. Tanya Brooks, a nurse, is already planning an exit she does not want. She loves her community. She loves her patients, and she hates that her children will have to start over somewhere else. But her homeowner premium, quote, hit $750 a year. Her property taxes rose and her child care costs climbed. Her monthly budget is a Jenga tower, and one more block will drop it. So she is packing. That is the breaking point in human terms, not anger, not ideology. A spreadsheet that stops working. If leadership is serious, it has to be serious about speed. It has to be serious about letting risk be priced in real time. It has to be serious about reducing litigation uncertainty, streamlining approvals, accelerating mitigation, and cutting permitting delays that leave homes vulnerable longer. It has to be serious about acknowledging that mandates and compliance burdens have a price. And the price is being paid by people like Maria, Robert, Aisha, Daniel, Sophia, Marcus, Jessica, Nina, Carlos, and Tanya. It has to stop treating the market like a villain and start treating the homeowner like the patient in critical condition. Because right now the system is performing a calculated retreat and calling it normal. The governor can keep promoting policies as if the only challenge is messaging. But when your homeowner policy disappears, messaging does not replace coverage. When your lender demands proof, a press release does not satisfy them. When your escrow jumps, talking points do not pay it. When your child needs medication, ideology does not lower the price. The insurance exodus is not waiting for election cycles. It is moving on renewal calendars. It is moving on underwriting spreadsheets. It is moving on the same relentless schedule as your bills. And if the state does not match that speed, it will be outrun by its own crisis. So here is the haunting question that hangs over every quiet street where the mail just arrived. If your policy can vanish even when nothing has happened to your house, what exactly are you paying for? And who is protecting you when the next domino falls? Look up your insurers' rate filings and withdrawal notices with the state regulator. Track the renewal quotes in your zip code. Document every non-renewal letter and every premium increase and compare them against the state's promised timelines for approvals and mitigation programs. Track the last resort plan growth. Track assessments and changes in coverage limits. Track permitting timelines in your county for fire hardening and rebuilds. And track how many homes in your neighborhood are being sold, not for opportunity, but for escape.